Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. It is Friday, September 26th, and you are tuned in to the Friday Chart Fix. Thank you very much for joining us. I do appreciate it. So here's what we're going to cover today. SPY has been above its 50-day moving average for 102 days. This is the seventh time since 2000, and we'll look at that price chart. Then we'll see the market is being led by the biggies, QQQ, MAG7, XLK, and XLC. But we're seeing weakness in small caps, mid caps, and equal weights here in September. So if we look on the surface, SPY and QQQ doing fine, but the percentage of stocks above the 50-day in each of those indexes is waning. So that is something to watch out for. We'll see that new lows are outpacing new highs within the S&P Small Cap 600. That's a potential negative. And we'll see that commodities are in a bull market, and even the DBC commodity ETF, which is heavily weighted towards energy, is showing signs of life. Let's hit the charts. So we're going to start off on Stock Charts ACP because there's an indicator that I want to highlight. At the bottom, we can see the TIP percent above MA indicator, and it is set at 151. So 1 is for the short moving average. 1 basically means the close, a one-day moving average. 50 is the other moving average. And so I'm showing the percentage above the 50-day moving average with this indicator. And 1 is a smoothing constant if you want to smooth that percentage above indicator in any way. But I'm just showing it as it is, a percentage above the 50-day moving average. And we can see here on May 1st, it turned positive. And that means the close was above the 50-day moving average. And you see on the price chart, we had that gap and move above the 50-day on May 1st. And then we had another gap in mid-May when we got above the 200-day, which is not shown. But if you go back to the indicator window, you can see that it has been above zero ever since. And it is now 102 days above the 50-day moving average. And this is the seventh time since 2000 that SPY has been more than 100 days above its 50-day moving average. Now, there were a couple of occasions when that streak got to 145 and 131, but the other four times, and this is not a big sample by any means, the rally fizzled out in that 100 to 150-day area. Now, this is not a long-term bearish scenario by any means. The long-term trend is clearly up. We hit a new high. We're in a bull market. That's okay. But the longer you get above that 50-day, the odds increase for a potential pullback. And if we get a pullback below the 50-day, that could be an opportunity to partake in the bull market and long-term uptrend. Now, one more item I want to point out here is you can see the percent above the 50-day moving average there. It's at 2.2%. So if you look at the price chart, there's the 50-day, and we're currently 2.2% above the 50-day, which is a pretty healthy margin. You can see it was higher on the liftoff in May and June, in July. And no, I'm not calling that a bearish divergence. It's just less. It's still upward momentum. It was just stronger on the liftoff when you got 5% above the 50-day. That shows powerful upside momentum. So momentum is slowed, which is normal. You can't maintain that strong momentum on the initial liftoff. But as long as we're above the 50-day, we don't even have a decent correction on our hands. But if we go below the 50-day, that could be the sign of a correction. We had one here in December and January, and then we moved higher into February, but then had the big breakdown into March. But right now, the call is just for, we're getting overdue for a potential pullback below the 50-day moving average. And so, as I said, this indicator is part of the Trend Investor Pro Indicator Edge plugin. And there on the bottom right, you can see the plugin link to learn more about those 11 indicators in the plugin. So there is a correction underway in the stock market in September. And how do we know that? Well, if we look at the performance for the equal weight S&P 500 ETF RSP, you can see it's down 1% here in September. Mid caps down 0.75%, small caps down 0.62%. So there is some correction action within the stock market. These ETFs are still in uptrends, but they are moving sideways or slightly down in September, which means there's some sort of a correction going on. Now, the heavy lifting is, of course, still being done by large caps, QQQ in particular at 4%, the Mag 7 ETF up 7%, technology up 6%, and then communication services up 5%. These four are doing the heavy lifting, and they are helping SPY, which is large cap dominated. It's up 2%. The technology sector accounts for 34.5% of the S&P 500 and SPY. So as long as these four are doing fine, SPY is going to hold up, I would assume. But if we start to get a pullback in these leading groups, then that could weigh on SPY, of course, because they carry such a big weight. But right now, it's a really bifurcated market where we have the strength concentrated in that technology area and Mag 7 area, and not much strength or weakness coming into small caps, equal weights, and mid caps. There is even a correction happening within the Nasdaq 100. Here we have SPY here, and as I noted, SPY is 2.2% above its 50-day, and in the third window there we have QQQ, and it's 3.2% above its 50-day. Both are comfortably above their 50-day moving averages. But if we look within these two indexes, we can see that half the stocks in the S&P 500 are above their 50-day moving average, which means half are below. So half of them are in some sort of a correction because they are trading below their 50-day moving averages. They're in some sort of a pullback. And if we look at the Nasdaq 100% above 50-day moving average, only 41% of stocks in the Nasdaq 100 are above their 50-day. That means 59% are below. The majority are below the 50-day. So the majority of stocks within the Nasdaq 100 are in some sort of a pullback mode right now. And if we look at this indicator overall, it was above 80 in May, June, and July. And then the market moved to new highs, but it couldn't get above 70, and it keeps deteriorating. So that is a bit of a concern here. And if we look at the Nasdaq 100, again, above 80% in May, June, July, and then got a hit in August and didn't rebound in September. QQQ moved sharply higher in September, but this indicator worked its way lower. So we're seeing continued deterioration within the Nasdaq 100. Now, I know it's a large cap world, it's a large cap tech world, it's a tech world, it's a XLC world with Google and Meta, but if you go outside of these groups, there is something going on where we got either a correction or a pullback underway. And the question is that going to extend into the bigger cap names like SPY, QQQ, Mag 7, and XLK? I think it bears watching. So if you'd like to see more analysis like this and in-depth analysis with a video report accompanying every report that I do, there's a written report with charts and analysis as well as a video. Check out trendinvestorpro.com. On the homepage, you can see an overview of the services that are offered. And if you want to see some of the more recent commentary, you can check out the current analysis and videos page. And that is this page here. And so you can see that what we have been covering this week, we covered gold and silver miners going parabolic. Oil is perking up. I've got a couple commodity ETFs to talk about next. And we picked 4 energy ETFs to watch with setups. And it's been a long time since I've talked about oil and energy. We reviewed the market regime page, still in a bull market. We looked at some individual stocks, in particular 4 utility stocks with breakouts. And that is because we're seeing a breakout in the utility SPDR, XLU, we highlighted that, as well as the breakouts in uranium. And actually we featured those breakouts in uranium in early September when they were happening, and we got some really strong follow through on those breakouts. So check out trendinvestorpro.com to learn more. So if you're out looking for individual stocks as far as trading candidates are concerned, or even ETFs, I still think we need to avoid small caps and mid caps. They're just not the place to be. Because if we look at the highs and lows for the S&P 500, the Nasdaq 100, the mid-cap 400, and the small-cap 600, we can see that there is more weakness within mid-caps and small caps. So here are the highs and low pairs for these four indexes. And you can see there were 19 new highs in the S&P 500 on Thursday and 15 new lows. So new lows are starting to expand a little bit, but we still have more new highs than lows. That's what counts. If we look at the Nasdaq 100, 4 new highs and 3 new lows. So again, not as many new highs, but still outpacing new lows. And the problem starts when we get to mid caps. You can see 12 new highs and 14 new lows. That's a net of -2. So new lows are starting to outpace new highs in mid caps, and that's more pronounced in small caps. 25 new lows and only 6 new highs, and that's the most new lows since August 1st. And if you go back up to the price chart, you can see on August 1st, we had a pretty sharp pullback, and then we rebounded. And we got a little pullback now. It's like the market has sneezed and small caps bear the brunt. You know, SPY was down like 0.74% over the last 2 days, and IJR, the small cap ETF, was down like 1.78%, more than twice as much as SPY. And you can see 1 day, 2 days down, and new lows all of a sudden expand to -25, 25 new lows. So that tells you small caps are still not the place to be. We still want to be focused on large caps and large cap techs. I think it's also important that we have commodities represented in our portfolio because commodities are in a bull market in general. Now, there's one commodity ETF that I think is pretty representative of the commodity group as a whole. In other words, it's not heavily focused on energy like the DBC ETF is, which I'll get to in a minute here. So here is the Wisdom Tree Continuous Commodity Index Fund. If you want to know more about this ETF, you can just type in for your search GCC Wisdom Tree Continuous Commodity Index Fund and go to their website to learn exactly what they're about. But if you look at the breakdown of the holdings here, we got energy around 19%, grains around 8%, industrial metals 17%, livestock almost 5%, precious metals, 22%, softs like coffee, sugar, 7%, and then crypto, 6.4%, and then other at 17%. So 6.4% crypto. And that little weighting in crypto has really paid off because if you look at performance for, this is performance for 4 different commodity groups. We got energies down 16.6% over the last 2 years. We got base metals up 6.6%, precious metals up 82%, agriculture up 25%. So the only one dragging its feet here is energy. And then, of course, Bitcoin is up 305%. So this is a performance line for these 4 commodity ETFs and Bitcoin over the last 2 years. And you can see Bitcoin's up 305%. So even a small holding in Bitcoin really helped this commodity ETF. But it's not just Bitcoin, okay? We can see precious metals clearly leading with 82% gain. If we look on the price chart here, you had this big breakout here in March, and then it's pretty much been working its way higher. Yeah, you had some pretty good dips along the way, but there is an uptrend here. And you got new highs here in September, and we're above the rising 200-day moving average. So this strength here in this commodity ETF tells me I want to be looking at commodity-related names as well as those large tech-related names. Now, I've never been a big fan of the DBC commodity ETF. You can see here DBC, and then you can see the holdings on the left there. Energy accounts for about 56% of the ETF. That is a huge weighting. This is a big play on energy. That would be mostly oil, and then gasoline, and then natural gas. And if you look at the bottom windows there, we have light sweet crude, WTIC there. It's been trending lower since April. And we have Brent, which is also trending lower. Now we're seeing maybe a little bit of a bottoming process in oil. We have a higher low here from May to September, and maybe an upturn working. It'll break above the 200-day would be positive. The same with Brent. And if I look at DBC, I can see some bullish price action. You had this big surge from that April low to that high in June. That was a really strong move, a big percentage gain. And then we came back down to the breakout zone. So you have a breakout zone. So we have broken resistance turning support. You have a 50% retracement. So this is like 2 steps forward, 1 step backward. And we have a falling wedge. So those 3 items there are typical for a correction after a big advance or after an advance. And you get into that broken resistance turning support zone, you get near that 50% retracement, and you have the wedge forming. That's a heads up. All right, we have a potential bullish setup. It's what I call a bullish setup zone here, down in that 2150 area. And we got a breakout there at the beginning of September with a big move, and we followed through with another advance into the end of September. We're not quite at the end of September yet, almost there. But we're moving higher. We're following through on this breakout. So I think that is bullish, and it says that maybe something is happening with oil. And I featured oil and 4 energy-related ETFs in the report and video on Trend Investor Pro on Thursday. So check that out if you'd like to learn more. All right, so to summarize, we're still in a bull market. SPY QQQ hitting new highs. It's led by technology-related stocks, XLK, Mag7, XLC, and QQQ. So it's a large cap tech-driven world right now. We're seeing weakness within the market, and that could foreshadow a correction. But as long as large caps, technology are holding up, then that correction could be muted. We're watching because SPY has been above its 50-day for over 100 days, so that's getting a bit extended. And we're seeing a bull market in commodities and oil perk up. And if you'd like to learn more about that oil trade, check out trendinvestorpro.com. So thanks very much for tuning in, and have a great day.